Welcome to the Seattle Investors Club podcast with Julie Clark and Joe Bauer, where we share the nuts and bolts of real estate investing from our 20-plus years in the industry. Sit back, relax, listen, and immediately take action. Are you ready? Here we go.
Welcome to the Seattle Investors Club podcast, where we talk about the nuts and bolts of real estate investing. My name is Joe Bauer. I'm here with my co-host, Julie Clark. Julie, how are you doing today?
I'm excellent, Joe, and I'm here with my co-host, Buddy Clark, who is also here today with us.
Oh,
hey, Buddy.
Yeah.
Buddy is our sidekick. For those of you who don't know who Buddy is, if you follow, I think our Instagram account might have some pictures of Buddy on there. Do you got some on there, Joe?
Buddy is on there, but he's going to be making a special appearance in the next few days, so check it out.
Excellent. Well, he is getting his hair cut next week in case we need to prep him for any serious interviews and things like that. But all right, Buddy, I'll take it from here. Thank you very much. So, Joe, for those of you that follow us on the nuts and bolts of real estate investing, you might be aware that Joe is on a year-long road trip with his girlfriend, Emily, hitting all the national parks and everywhere in between in his kick-ass, I don't know what I want to call it, sprinter van, the Fantastic Life. You can follow him. So, Joe, every time we do this each week, we want to know where you at. So what's up?
So right now I'm at a sweet little campground outside of Lawson Volcanic National Park, which is in Northern California. It's pretty darn cool. We went and saw some basically like boiling water coming out of the ground on some trail runs yesterday. It's quite the place.
That sounds a little bit like Yosemite National Park to me.
Yep, not or very similar to Yosemite National Park. I would say just about a hundredth less people.
Right on. That sounds good. It's probably 800 degrees out there?
It's probably about 78 right now.
Nice.
Yeah.
Good stuff. Well, I'm in Seattle, sitting enjoying the beautiful weather. It's going to be like 85 here today. Totally awesome. And our guest today is in San Diego, another beautiful place. What's up? How you doing, Bill?
I'm doing terrific. Thank you.
I'm going to let Joe introduce you and take it from there.
Well,
Okay.
Yeah. We have Bill Exeter on the call today. And Bill, we always start this podcast out with just trying to get to know you a little bit better. So if you could share your history, how you got into real estate, and what you're doing now, we'd love to know.
Sure. I actually ended up in a commercial bank in Los Angeles as the controller. And the chairman of the board had decided to start a 1031 exchange company. And this is about 35 years ago. And outside counsel said, hey, don't give it to the escrow subsidiary. So they threw it at me, and I had no idea what a 1031 exchange was at that point, and had to get up to speed pretty darn quick. And that's what got me into real estate and into 1031 exchanges. And the rest is history, as they say. So we've been doing 1031 exchanges and trust services for 35 years.
That's awesome. Has anything changed in your business in the 35 years? Like everybody used to do this and now they do that, or what?
Yeah, quite a bit. When I got into the business, the IRS still hadn't issued regulations. So it was kind of the wild, wild west. And, we'd go to some small group meetings, and it was kind of like, this is how I do it. How do you do it? I don't know. What do you think? And everybody was just trying to figure it out because the IRS hadn't spelled it out yet. So that was in the early 80s. And then the regs actually came out in 1991.
Wow. Yeah. And then what an advantage to be on the inside of how all that rolls. Are you also a real estate investor yourself, or do you focus morely? Are you smart enough to know that people are out there overpaying for all their deals and right now?
True. I do invest myself. Have some single family duplexes and whatnot. Haven't bought any recently. I think the market's frothy, if you want to put it that way. And
but we'll
certainly see a lot of people buying stuff.
Definitely frothy. I said it is definitely frothy, but we are experiencing a leveling out slowdown. I don't know if you guys are down there in San Diego, but Seattle since June has completely shifted. So I think we capped out. We're starting to, unless something's priced low, it's list it for what you expect to sell it for. I think it's still a solid market, but definitely having a change over here.
Yeah, we've seen kind of the same thing. I think our transaction volume for July is leveled out quite a bit as well. So I think that's exactly what we're seeing.
I always wonder so you are an 1031 exchange facilitator or qualified intermediary. Would that be the correct way to say it?
Yes, absolutely.
So this is kind of a little side note here. So I work with my favorite stager, which is White House Staging, Stacy Masterson out here in Seattle. And I find it interesting to ask different people in different parts of the business of real estate, because she is staging 25 homes all at one time, for investors, for regular agents and so forth like that. And she has a different vantage point and sense and feel of what's going on in the market based on when she's being called to pick up her staging, right? It's like just a simple insight. And she can sense how long. She says that starting in June, I think she said that her inventory was sitting out for like way, way longer for the first time in like 4 years. So just because she's a stager, she had a touch of knowing that the shift had happened. And I find that super interesting. And I'm wondering if there's anything in your business that you sense from your perspective.
Well, we're kind of the opposite. We're kind of the trail end of that, if you will. Once everyone has listed and sold and opened escrow and whatnot, then at that point they contact us. So we kind of get the tail end of that, if you will. So we're not really a leading indicator. But we do see trends that kind of bounce all over. We've seen a shift probably a year ago or so where in the multifamily market, people are selling maybe A-class properties and going into C plus, B minus, and then doing a little rehab and, bumping it to a B plus property. And so they're doing value adds. Yeah. So I think that makes sense in this type of a market. So you're seeing shifts like that because people are trying to obviously figure out how do we make money in today's market. And then we're in California, so we see a lot of people who are selling California and buying in other states where the cash flow makes more sense.
What states are they buying in? There's a little insider tip from...
It's all over the place. You see a lot of people who buy in states that have no state income taxes, so they're kind of repositioning for the future sale where they won't have to pay state taxes. You get people who are going into a lot of the areas like Tennessee and Kentucky and what have you, where you can get some really good prices. You get a lot of people go still into the Sun Belt because that's where really the growth is forecast for the many years to come. So it just depends on kind of what their goals and objectives are, but a lot of repositioning.
Yeah. Are you seeing people in these hot metropolitan markets, we'll say, or like Seattle and things like that they're starting to not cash out because we're talking 1031, but they're starting to trade out because we maybe are saturated or hitting some sort of peak, and they're taking advantage of that sale and moving their money somewhere else?
Yeah, we certainly see a lot of that. Then you get the other group who doesn't really want to leave the area. They don't want long distance management issues to worry about. So then the question is, what the heck do you buy? And I think that group tends to be more of the value add, value play type investor. Then you get investors who are just repositioning, trying to put themselves in a better position, but they're not really changing the market they're in.
Right.
So hopefully the property they buy is a better property.
Right. I mean, it's crazy. Everybody's going after value add. I mean, I tell you, I feel like even in the smaller investor world, not the institutional investor world, all of a sudden everybody's looking for multifamily and buy holds, and it's amazing how it just like the coin flipped over, and that's everybody's focus right now. It seems like at all levels of experience and all levels of value. Seems to be the hot topic right now. And it's crazy to me. People, when they start investing in multifamily, they should maybe initially invest for cash flow, right? But those value add deals are hard to find,
Very true. And I think in this market, you have to invest for cash flow because, it's pretty pricey.
Right. I guess some people are probably forced to invest for just appreciation and park their money, though, when they have exchange needs and have to meet those deadlines. Do you feel that you have people that sometimes buy stuff that they just buy it because they're forced to buy something because they don't want to break the deadlines?
Yeah, we certainly see that. A lot of people who just jump at something, you get toward the end of your 45-day identification period and you panic and they kind of go after anything. And we always try to, tell people, don't let the tax implications, drive the decision. It needs to be an economic decision. And then if you can defer the tax, that's great.
Right.
But it really has to be a good business decision. But it's amazing how many people just buy junk just so they don't pay taxes.
Right. Let me ask you that. So there's a little, maybe there's a synergy. Do you get brokers calling your office directly saying, hey, I've got this pocket listing on this multifamily. Do you have any 1031 buyer needs?
We do. Yeah, we get calls quite a bit. In some cases, we can refer business. In a lot of cases, the clients are working with other folks and we never really get a phone call from them, so we don't know what they're up to or if they're, have a need. But it doesn't hurt to reach out and give us, flyers, whatever you might have on the property, a package. And
then you pass it on to their broker. I mean, there's ways to structure any deal. I just think that you guys are such a great resource for buyer needs. It's,
True. Yep, absolutely.
True that. Okay, well, we got a little sidetracked there, of course, like we like to do. So let's kick it off and just say, maybe just to start things off, maybe we can cover the different options, like a 1031 exchange, and beyond that, this is all available on your website as well, but maybe what an installment sale is and how that's different, or a structured sale. And maybe some of the other options, zero equity 1031 or improvement 1031, without a deep dive into the details of each. Can you just share with us, what those are and what that means and how they're a little bit different?
Absolutely. So the 1031 exchange, of course, only applies to rental, investment, or business use properties. And it gives the investor a chance to sell the asset, defer the payment of their capital gain taxes, their depreciation recapture taxes, and avoid the triggering of the Medicare surcharge or the Obamacare tax by going through the 1031 exchange. And they just do that by reinvesting in other rental, investment, or business use property by trading equal or up in value. So it's kind of a straight across the board or up. If you sell for $1 million, you buy for $1 million or more. And by doing that, they defer all the taxes. It's not tax-free, it's tax-deferred, and just keeps kicking the can down the road. And then, of course, when they decide to continually exchange throughout their lifetime and then pass, whoever they leave the property to will get a step up in cost basis. So at that point, it does become tax-free. Depreciation recapture completely goes away. So that only applies to rental properties. And it assumes that the investor wants to stay in real estate, so it allows them to defer the tax as long as they're reinvesting equal or greater.
And when they go to pay that tax later, they pay it at whatever the capital gains tax rate is, right? I mean, so
exactly.
Do you find that people, I don't know, what are we at today? What are we at today on the capital gains tax? Is it 15 or 20?
It's either 15, depending on their tax bracket.
Right. And do you find that, I don't expect that's going to go down anytime soon, do you?
No, it would kind of surprise me. I think we've had all the tax cuts we're going to get for a while. I think you're right
there. So, I mean, definitely beneficial to defer that. And then people don't understand probably what depreciation. I own apartment buildings and have bought and sold apartment buildings myself, so I understand the pain of what depreciation recapture is. Is that, do you know, you're not a CPA, so we're not holding this to you, but if I recall correctly, it's around 25% tax rate?
Exactly, yeah. So if you've got an investor who's, let's say, bought multifamily, then every year they're going to write off a percentage of that or depreciate the property on their tax return. And let's say 10 years later, they just decide to sell and not do a 1031 exchange, then they're going to take all that depreciation they've taken over the years and add it back to their income, or what they call recapture it, and it's all taxable. At the federal level, it's 25%, and then whatever the state rate is. So that's, in a lot of cases, that's a big surprise. People don't think about the depreciation recapture until it's too late.
It takes a big bite out of your proceeds,
Absolutely does.
Ideally, because if you're not making any cash net proceeds out and you got to pay that could be troublesome, to say the least.
Absolutely. It's usually a surprise, and it's not a good surprise.
Not a good surprise. So what that means, guys, is that, when you own let's say an apartment building, and you have your net income from operations at the end of the year, you also have what I'll call balance sheet. You get to reduce that number by the amount the property depreciates over. So you could essentially, in some cases, even have a tax loss sometimes, but still be collecting cash flow from your property because you have a it's just on paper, right? Does that make sense?
Yeah, absolutely.
Yeah. But then what happens is then when you go to sell the property, that we'll call it phantom loss, or that phantom income comes to light, and you have to deal with it. It's a big deal. If you guys currently own apartment buildings and you don't know what depreciation capture is, it's worth a call to your CPA right away to have them give you some scenarios, even if you have to pay them like a consulting fee to break it down for you, so you understand what we're talking about here when you go to sell one of your properties. And that's why we're talking to Bill today, because maybe a better choice for you is to defer those capital gains and those taxes on depreciation recapture. And then what's the Obamacare, the Medicare surcharge? Is that like 3.8%, or is that number bounced around?
Yeah, there's actually two. So there's a 3.8%. There's another one that's at 0.9%, and they get triggered based on different things. Typically, the Obamacare is anything that is interest income, dividend income, or capital gain income. And if it exceeds a certain level, depending on your tax bracket. So that's one of those things that really catches people off guard because they're not thinking about the Obamacare tax. So if they do an exchange, then any of that income, that capital gain depreciation recapture, is deferred, so it doesn't get counted toward the Obamacare limit.
And that's on top of the capital gains tax, the depreciation recapture, and this is on top, right?
Exactly. Yep, that is on top, and it's frustrating because people just don't think about it. And then when they do their tax return, they get surprised.
Right. I remember when that came out back in the day, because I'm also a commercial broker, brokered my fair share of land deals to the institutional guys and stuff like that. But dealing with sellers of those properties, they were writing into the contracts right when that thing was getting passed. If it gets passed, the price on the contract was going to be adjusted by that Obamacare thing. That was a big deal for a while, caused a big pause with sellers having to negotiate that into the contracts back in the day. I'm aging myself a little bit, but
yep, it was certainly a surprise, and it kind of gave everybody a chance to sit back and kind of rethink it for a while.
Exactly. All right, so we're going to jump back on track again here. So 1031 is when you want to defer your capital gains tax and all those other crappy taxes on top. Either indefinitely, if you can defer them until you pass and it goes to your heirs because they get a step up in value. That's one option. How about installment sale? What's the difference with an installment sale?
Installment sale is really when you're selling property and you've decided to do a seller carryback note and you're helping the buyer finance the purchase, essentially. So you're acting as the bank. The difference is that you've actually sold the property, triggered the gain, but you can defer it over the term of the installment note. And there's a lot of moving parts there, so it kind of depends on how you structure it. But typically, any cash that you get in your pocket at the close of sale would be taxable, and then any other gain that's not taxable would be deferred over the term of the note. So it's kind of one way to get out of the real estate investment, not have to reinvest, and then defer some of your taxes over maybe a 5-10 year period, depending on how long you structured that note. So really the difference with the 1031 is it is deferred into the future until you sell the property.
Not triggered at all.
It's not triggered. And with the installment note, you've triggered it. You just get to defer it until you start to receive principal payments over the period of time.
Let me ask you a question on installment sales. So I sell a property, I carry back a note, and I've got a 5-year term or whatever the term is. But I know that my own personal tax bracket is going to be changing because I'm retiring or something like that, right? On the installment sale, does the cap gains tax applies if my rate was going to go down because my tax bracket was going to go down? Do I benefit from that capital gains tax at the lower rate? Let's just say if I could qualify for that when in the year that I take that money down the road?
Yes. So each year, a percentage of your capital gain will be taxable depending on how much principal payment comes in. And you'll pay tax at that year's capital gain rate. So if you're going into a lower tax bracket at some point in the future, as you get those payments in or even get a payoff, you'll be taxed at the lower tax rate. So if you know that's going to happen for sure, that would be one way to do it, and make sure you get taxed at the lower rate.
Right. I mean, there's some planning that needs to go into that kind of thinking for sure. But the interest income is ordinary income, I think, isn't it?
That's right. Yep. There's no way to avoid that.
Right.
And other people, they want to get out of real estate, but they don't want to get hit all at once, and they don't want to have an installment note where it kind of forces the payment at some point in the future. So what you can do, which is kind of a blend between the two, I guess, is kind of a partial 1031 exchange. So maybe you sell an asset for $1 million and you reinvest at $900 or $950, and then you can specifically plan how much gain you're going to trigger in that particular year. And then maybe a year or two later, you sell again, do another exchange, and trade down a little bit more. And so you can slowly take your chips off the table, so to speak, and kind of control how much gain you trigger in whatever year you're looking to do that in.
Oh, interesting. Partial 1031. So that's totally different than our next category. That's different than a structured sale, correct?
Yes, it's still a 1031 exchange. And unfortunately, there's a lot of material out there that says you have to trade equal or up in value with a 1031 exchange. And that's not true. You can certainly trade down, but it will trigger taxes. So generally, the amount you trade down by, or in other words, you don't reinvest, would be taxable. It doesn't hurt the rest of the 1031 exchange. It just means you're going to pay some tax.
That's a very valid point. People might be confused about that. You hear that, guys? You do not have to trade up or equal. Basically, if you need to do a 1031, you need to call Bill, but we're going to talk about that at the end. It's like going to the restaurant. There's a lot of options, right? There's a lot of options. So it depends on what your diet is and what your dietary and nutrition needs are on how you need to structure these things, right? And what's going on in your life in the future and this and that.
Absolutely, yep. And along the 1031 lines, there's another exchange called the 1033 exchange, and a lot of people haven't heard of that. The 1031 usually is a natural disaster where the property's been destroyed either fully or partially, and they submit a claim, get an insurance check, and they reinvest by repairing the property. So they've done a 1033, they just don't really realize it. But where I think it has a lot of impact is if you're in a position where you're selling property to a government agency and they have eminent domain authority, or some people call it condemnation authority. If you can get them to take your property through eminent domain or threaten you with eminent domain, then you qualify for the 1033 exchange. And with that one, you have anywhere from 2 to up to 5 years to reinvest, depending on what section of the code you fall under. So much more flexibility in terms of timing, and you can actually pull cash out, and it doesn't trigger cash boot like it would in a 1031 exchange. So the 1033 has got some neat planning opportunities.
That's a 1033?
Yeah, 1033 exchange.
Well, that's interesting, especially up here in the Seattle area where we have all our light link rail projects and those sort of things going on, where we are having the eminent domain things happen as we build out our infrastructure here. A little tip for all you ninjas out there that like to be doing the deep dive. I can think of a few of you people I know off the top of my head that should be paying close attention to this 1033 exchange You could maybe even reverse engineer some ideas around that, guys. There's your another little ninja tip of the day from Seattle Investors Club right now. But that sounds pretty cool. Makes me think. So what's a structured sale?
Structured sale is similar but different than the installment sale, and we have to be careful here. There's probably 4, 5, 6 providers out there who've come up with different structures, different ways to do the structured sale. They call them different things. They'll all say that they're drafted under Section 453 of the tax code, which is the installment sale code. So it's the same exact section of the tax code that the installment sales fall under. The difference is they're drafting things a little differently, they're approaching it a little differently, but they're saying it's drafted under Section 453. And at this point, there's really no IRS guidance on the structured sales. There is one where there's a court decision that kind of covers the structure. So in structured sales, you're effectively the same thing. You're selling property, but you're doing it through a structured sale. You're triggering your taxable gain, but you're deferring it through this structured sale mechanism. So it really depends on the term of the structured sale and what have you. With this, because there's no guidance from the IRS and only that one court case, and a little bit else out there in terms of special rulings from the IRS, I'd always talk to your accountant first and really do some research and make sure what you're doing is going to be, work and it'll qualify and you're comfortable with the risks there. We'd like to see a lot more IRS guidance in this area if possible. At some point, we'll get it.
What is the concept, though, that you can pick your term, or what's the difference between installment sale and structured sale? Because they both trigger the gain, and they both. Yeah,
good question. They both trigger gain. The difference is with the installment sale, the buyer's still in the picture. So you've sold property to the buyer. The buyer has executed the promissory note as the buyer and borrower. With the structured sale, effectively you're kind of selling the property through some type of a mechanism, either a trust or something like that, and then the trust turns around and sells it to the ultimate buyer. The buyer is actually paying for the property either through cash or financing, and then the buyer's out of the picture. So it's one way to do it when the buyer doesn't want to hang around. And people are worried about the buyer if they do an installment sale and the buyer trashes the property or defaults on the note or what have you. There's risks. So the structured sale kind of results in a sale, defer the tax over the period of time you choose, but the buyer's not involved anymore.
So
the risk with the structured sale is there's no IRS guidance.
Right. So if somebody was to slap somebody's hand on a structured sale, so it's a way to not have to worry about foreclosure and having to take a property back because it's more of a cutting it off sale situation, but you might get a spanking from the IRS or something, or the potential's there for some weird audit that then might put you back in the position of an installment sale, or?
Good question. If an audit were to occur and they disqualify the transaction, it could recognize immediate tax consequences. It depends on what position the service would take.
So you got to be a little bit of a cowboy and a pioneer, or cowgal and pioneer woman to maybe dive deep into that. We won't make you go into details on that today, just covering basically the basics. Let's move on. What's a zero equity 1031?
Zero equity is something we trademarked a while back, and it really happens mostly during recessions. So as an example, let's say you buy property for $100,000 and then over 10, 15 years it goes up in value, and every couple of years you refinance, you're pulling your equity out, but you haven't sold it, you haven't paid any taxes yet. And at some point in the future, let's say it grows in value to $1 million, then you keep refinancing. And at that point, you've got $1 million value, maybe $900,000 in debt, and then a recession hits. So let's say that $1 million property drops in value to maybe $600,000. So it's a 40% drop, but you still have a $900,000 loan. So it's worth less than what you owe the bank, but you still have a taxable gain because you only bought it for $100,000. So a lot of people will, if they lose the property through foreclosure or something like that, they think, well, I'm losing the property, so I don't have a tax consequence. And the reality is you've refinanced over and over and over. You've pulled your gain out, but you haven't paid tax on it yet. So it's still sitting there. So when they lose the property through foreclosure or deed in lieu of foreclosure or short sale, whatever, you can still do a 1031 exchange even though you have no equity. The challenge is, how do you pay for replacement property when you have no equity? So it can be done, and we just want to get the message out there. If you're underwater, it's still possible to defer the taxes. First thing, talk to your accountant and find out if you've got a tax problem. That's the big one.
Right. That is good to know. These are all just resources, guys. I mean, Bill is somebody that you should have on your team no matter what. It's just like, the basics of your team. You got your title and escrow people, you got your attorney, you have your CPA, and now you have Bill Exeter from Exeter 1031 as a crucial player on your team, no doubt, for sure. Especially, I feel it makes me nervous, that people are paying top dollar for all these buildings, yet there's more buildings being built, apartments being built, and we're starting to have absorption issues. And, there's a lot of people that I call it, there's something called the Peter principle. Do you know what that is? You guys know what that is? That's when you've done something well. Let's say you flipped houses and you did real well, and so you've started, building a few houses. You're now a developer, right? You're a home builder because you flipped houses, and now you're a home builder, and you're doing well at that because you're hitting the market when it's super hot. Well, then all of a sudden now you're going to start, buying all these apartment buildings because you got the golden touch. Boom. The Peter principle is, I think what it means is when you think you're good at something, that you think you're an expert in the rest, and then you get a spanking, right? That's the Julie Clark, not the Wikipedia version of Peter principle, but be careful.
And it hurts.
It hurts. That's a spanking that you don't want to get. I know some of you dirty birds out there might want a spanking, but you don't want that kind. Let me tell you what. I always got to take it to the gutter a little bit, Bill. We got to make sure these guys... Right.
So
I don't know,
true.
Joe, if that qualifies for that you can, whatever you read on these podcasts, expletive or whatever. But I attempted to get in the gutter right there for a second, guys. Sorry about that.
Who's got that bleep button?
Yeah, right.
Well, the beauty is we don't have one here at Seattle Investors Club. Okay, well, last one, and then we'll get on to some other stuff. What's the 1031 improvement? Is that something that we need to know about?
It can. It comes into play occasionally. So if you've got somebody who is selling property and they're going to buy a replacement property, like maybe dirt, and they have exchange funds left over and they want to use those funds to build out the property, you can do an improvement exchange. So you sell, buy dirt or buy something you want to improve, and then use the 1031 exchange proceeds that's left over to pay for whatever the improvements are. So a lot more complicated. We have to hold title to the property. It's what the IRS calls parking title, but can be done, and it's a great way if you want to use some of the exchange proceeds to make the improvements. So
for all you Peter Principle followers out there that want to break out of your, apartment building and now go buy some apartment dirt because you think you're going to build one, that might be for you, right?
That's true. Yep, absolutely.
I'm just teasing, guys. You guys go for it, right? I'll be your broker. Just call me when you need me. All right?
I just know I'm going to get a phone call right after this and say, hi, this is Peter. I'm like, oh, God.
Exactly. Okay, so we already covered, what we're looking to, the components of taxation. 1031, guys, we know 1031 exchanges and all these other types of installment sales and options to protect your hard-earned equity are meant to avoid taxes, which there's a lot more taxes than just capital gains for you guys to be aware of. We got your depreciation recapture and all your thank you, Mr. Obamacare stuff. But let's go into just a little bit of, nuts and bolts, for lack of a better word. We love that word. On the timeliness, the basics there on a 1031. It's 45 days, to identify, 180 days to close, that kind of thing.
Exactly. Yep. And I think the most important thing to remember is you've got to get the exchange set up and in place before you close on anything. We get calls literally every day where they closed last week or yesterday or something and they want to do an exchange. And once the closing occurs, it's too late to set up the exchange. So always get everything set up, signed, and ready to go before you close. And then closing is what triggers it. So a lot of people think it's when you execute the contract or open escrow or things like that, but it's not. It's the closing that actually triggers everything.
Okay.
So when you close on the sale, you convey title to the buyer. That triggers your 45 days to identify. And that's the tough part. 45 days moves very quickly. And in today's market, trying to find something in 45 days that is suitable and makes sense it can be really challenging.
Very much. So does that 45 days includes weekends and everything, straight up 45?
Yeah, so basically you got 6 weekends to find property.
Almost impossible. I've been telling my clients, like, if you want to do an exchange, I have somebody that wants to exchange out of 2 single family rentals right now and buy an apartment building in Tacoma. And I said, well, we really almost need to have an idea and get talking to brokers about pocket listings and this and that and identify it before we get started, because the houses are going to sell fast, and that can be hard to fill those shoes. So what happens? So you have 45 days from the date of closing that you can identify up to how many properties?
Usually it's 3 properties. There's a couple of rules you can look at. So most people are going to, probably sell one and buy one of a little bit more value. If they're selling for $1 million, they're probably going to buy for $1.2 million, $3 million, $1.5 million, something like that. So they'll use the 3 property rule, identify up to 3, but not more. If you are an investor, go ahead.
What happens if, you're trading out of something and you might have to buy 2 properties instead of 1? Now you got an issue because you got your 2 that you need to buy and you only got 1 extra, if you get what I'm saying. Yeah,
kind of 1 backup slot to use, so to speak.
Right.
And the tough part in today's market is you may identify 3 with the intent to buy 2. And if one of those 2 doesn't work out for some reason, the 3rd property you identified as a backup property is probably long gone. So
right.
It's, normally you'd identify 3, some of them would be backup, and that works perfectly well. But in today's market, it doesn't. It's a challenge. They're probably long gone. The second rule, which you may look at if you're diversifying, some people are selling 1 property and going to try to buy 2 or 3 or 4 smaller properties, is you look at the 200% rule, and that just says whatever you sell for. So let's say you sell for $1 million, 200% would be $2 million. You can identify as many properties as you want up to a total of $2 million in value. So it's either or. It really depends on whether you're going to trade up or if you're going to diversify.
Okay, 200% rule. That's very, very important, because I was like sweating right there. But now that makes it a little bit more. That makes it sometimes can be a little bit more of a relaxed. Not, I wouldn't say relaxed in this market, but yeah, the problem is they're all gone, right? You almost have to, in order to get a 1031. You have any tips on how to do that for people out there that are in need of that? You almost have to set it up ahead of time, identify it ahead of time, get going, and maybe can you put an option down, or I don't know, lock it down somehow?
Yes. In fact, you hit the nail right on the head. So 1, you want to get started ahead of time. Don't wait until you're in the 45 days. If you do, you're just asking for trouble. Start looking for property. And then there's various ways to do it. So if you happen to sell first, see if the buyer's willing to cooperate. It's still a seller's market. So you may be able to say, look, I'll sell to you, but I want, a long escrow. I want options to extend by 30 days for 2 or 3 times. If you find the property you want to buy first, you can put it under a lease with an option to buy or just an option, first right of refusal. If you can somehow tie up the property so you don't close on it, but you have control over it, then you can time your closings just right. So It really kind of depends on the market, and it depends on what the other party's willing to do and how cooperative they are.
It's a jigsaw puzzle a little bit. It's all doable. Otherwise, that's why you're in business. It is all doable, and it's all worth it if you can pull it off. But you guys definitely need to be working with somebody that understands the components and all the moving parts. Don't use your brother who's a broker because he wants to get that commission and you want to give it to him. You need to have an experienced A-team that can help you with this sort of coordination. So again, I'm available, but let's just say you guys get my...
That is true, though. That's exactly right. Because if you get somebody who doesn't really get it, you're going to be in trouble.
You're going to be in trouble. Exactly. Well, let's talk about some of these other... okay, we have 45 days to identify, let's say, 200% rule or up to 3 properties. And how many days to close?
And then you have, beyond the 45 days, you have an additional 135 days to actually close and wrap up your exchange, and it's a total of 180 days.
Okay, so it's 45 plus 135 equals 180 combined.
Exactly. The other thing they can look at is a reverse 1031 exchange. This is probably about 3% of the market, so it's not for everybody. But the reverse allows you to actually buy and close on your purchase first, and then you have 180 days to sell your current property. And so it works really well in today's market because you actually close on your purchase. It takes the risk out of it.
Right.
The problem is that, a pure reverse means you can go out and buy a new property, take title to it, own both, and then sell the old one later. And that's not permitted. So they've come up with this mechanism where it's a parking arrangement. So we have to take title or park title to the property. And so lenders aren't terribly thrilled with that. The question is, you're buying first, you haven't sold yet, your equity's trapped. So how do you pay for the new property? So there's issues there. It's a lot more complicated. But if the investor's in a position where they can buy first and pay for it somehow, then that would solve a lot of the risks. But
do you have a list of lenders that are user friendly for that sort of stuff? If some of these people wanted to use your firm for their exchanges, are you familiar? You have like a...
We do. We have some. Usually what will happen is it depends on the geographic area. Usually it's going to be a lender who covers that local area. Anybody who's a conduit lender, that's going to make a loan and sell it off to Wall Street, any of the big banks probably won't touch it. So it's probably going to be a local community bank, a regional bank, or a bank that you've got a relationship with that'll do that. Or it's going to be hard money, private money, or seller carryback or something like that.
Right. That gives me an idea, Joe. I know you're there. You're probably like on a hike at the top of a mountain listening to this right now. I know, but we should check into some community banks meet and greets for Seattle Investors Club. Just a little admin note on the side, guys, while we roll through this, because it's just like we're three pals talking to each other today. We're not actually having to please anybody but ourselves. That's why we love this podcast. Okay, that's all good info on the time frame there and reverse exchanges. Let's see. Let's go down to those questions that we thought you had some ideas, some tips and some problems you see with what investors are asking you these days. Kind of your list of stuff that we looked at this morning, Bill.
Sure. Probably one of the biggest areas we get questions about is, well, what type of property qualifies for 1031 exchange purposes? And it's amazing all the different opinions you get out there. So probably the biggest one is, how long do you have to hold title to property in order to qualify? And the code, the regulations, the rulings actually has no holding period. So when people tell you that you don't qualify because you haven't held title for at least 1 year or 1 year and a day, that's not really true. I mean, the whole issue is, if you get audited, can you prove that you had the intent to hold the property for some type of rental, investment, or business use? And if you can, you qualify. So the 1 year mark, it just makes it easier to prove intent because you straddle 2 tax years and you got 12 months of rental income. 24 months, that's 2 years, 3 tax returns, makes it much easier to prove intent, but it's not a black and white answer. So if you can, if you've held property for a month and then you sell again, so you've only had a 12 or a 1 month holding period, you can still qualify if you can prove that you had the intent to hold. So, as they say, stuff happens. So you may have bought a property and then a month later you get an offer that's double what you paid for it. Most of us would jump at that. So if you can show that you really had the intent to hold it, but you got this offer out of the blue and you can document that, then you would still qualify for another exchange. So don't get hung up on the length of time you've held title to the property. I mean, that's certainly a big part of how you prove intent, but it's not the end all to the whole equation. It's all about what your intent was, not the length of time.
So that covers qualifying for a 1031, right? There is no rule to hold it for any length of time. It's based upon intent to qualify for a 1031. But in order to kick yourself from ordinary income to a capital gains tax bracket, that could be a different requirement. Is that sound accurate? Meaning that if I guess if you're exchanging, that's the point. You're trying to defer your taxable whatever, regardless of whatever the tax bracket is. That's the point, right?
That's a good point. Yep. If you're doing a 1031, it's deferred. If you're just selling and cashing out, then the 12-month mark would be important.
Right.
Once you get over the 12-month, then you're considered capital gain versus ordinary income.
Right. So I want to make sure we're making that distinction clear to you guys, right? There's no rule on holding it for a 1031. Obviously, your intention there is to defer your taxes. But if you were cashing out and you weren't doing a 1031, yes, that 1 year does make a difference in your tax bracket or your treatment of the taxable income, ordinary versus capital gains. So if none of you understand what I just said, don't call me, call your CPA.
So true.
Well, what else you got? You got some land. What's your next one up here?
A lot of people, there's still a lot of curriculum and courses out there that'll tell people if you sell a condo, you have to buy a condo, et cetera. And that is not true. Any kind of real estate qualifies as like kind. So the only requirement is you have to sell real estate and buy real estate. So as long as it's defined as real estate, it counts. So vacant land would be like kind to single family, to office, to industrial. It's all like kind to each other. Even stuff like oil rights, mineral rights, gas rights, air rights, water rights, all of those are usually considered real estate. So it would count. You can sell a single family and go out and buy some oil and gas interests.
Wow.
Interesting. We know Brian if you're listening to this, Brian Faust, that might interest you. You probably already know that. But also, though, we want to point out we're talking about rentals, not your personal residence and any of this stuff, just to uber clarify that.
Absolutely. Yep. That's exactly right.
What about a vacation home? That doesn't count, right? Or if you have to rent it out for 14 days a year and you can qualify, or what's the scoop there?
Yeah, good question. So if it's 100% personal use, it's not going to qualify. But again, it all boils down to intent. So they can always change intent. So what you're referring to, the 14 days, is a safe harbor the IRS has. So if you can rent it 14 days per year for 2 years in a row and keep your personal use to not more than 14 days, you qualify. Or you just stop using it personally, completely rent it for, I would say, at least 12 months. I'd try to go a little longer. And then you've converted it to rental property. So then it would qualify.
Well, geez, I got a complicated question for you these days with our modern world. How about Airbnb? We actually have our Seattle Investors Club meeting, little side note here. If you guys are listening, we've already had that meeting because these podcasts are delayed as far as their release. But this meeting, this weekend, July 14th, we are having a Seattle Investors Club meeting with the topic is how to use your short-term rental income or your Airbnb income to count that income in your loan qualifications and stuff with our buddy Albert Bowie, who's a local investor and lender as well. So how does it work? What's the Airbnb play into your world, or is there one? If somebody
there is. Good question. So if it's a single property and the entire property is being rented out on an Airbnb type strategy, it would absolutely qualify as rental property. In some cases, it's a house that you're still living in and you're renting out a portion of the house, maybe a couple bedrooms or something. So then it's probably a split use type scenario, and it would depend on how all the parts kind of come together. If it's your primary residence, then you get the 121 exclusion when you sell it. That's the $250,000 tax-free per person if you own it and have lived there for at least 2 years. And if you're also doing the Airbnb at the same time, you'd first want to see if you can qualify under that tax-free exclusion. And if everything's tax-free, you're done. If your gain is more than that, then you probably say, okay, 60, 70, 80% of the house is my primary residence. That portion of the gain is tax-free under the 250 or 500, and the rest could be allocated to a 1031 exchange since you're renting it through Airbnb. So there's a lot of moving parts there. It kind of depends on each person and how they've structured it, but there's absolutely ways to kind of manipulate that when you're getting ready to sell.
That is fascinating to me as far as like a big whiteboarding effort to map out your stuff. I mean, it's a lot of effort, but if you like to geek out on that sort of thing, I know some of you out there do. What a cool mastermind group that would be to meet up and do that. If anybody wants to do that, hit me up at Julie at SeattleInvestorsClub.com. If you have a property or a scenario and you want to talk about it and share it with all of us, that would be a very interesting exercise to go through. That would be cool. And maybe we can figure it out and run it by Bill and get his feedback. That'd be pretty interesting. So what if I have in my own house, I essentially rent out a room to my nanny, who I love very much, so I can live my life. That I could kind of do. Wouldn't that be kind of considered if she's been there for 5 years, and that I could use that portion as kind of feels like it. You just said that.
Yeah, if you're renting it out to the nanny and she's been renting it from you for 5 years, that would absolutely qualify. We usually are very comfortable once you get past the 18 to 24 month mark, because you've got plenty of proof that was the intent. And so usually the accountant will sit down with you and allocate how much of that is considered rental property versus your primary residence. And they'll usually calculate it on like square footage, or if it's a ranch or a farm, it might be based on acreage, something like that.
Here's something interesting, though. What about a family member? What if, people's parents are aging these days? Does that disqualify? I mean, my mom pays rent at a retirement home, right? Mm-hmm. So what if some point I moved her in here and she paid me rent on an actual lease? Can I? That
would certainly qualify. You can rent to family members. You just want to make sure that it's fair market rent.
Hello, I've got a new tenant coming then. There
Hello,
we
Mom.
go. There, you guys. I hope you guys are listening, because a lot of people these days are cohabitating, and if you just got to get your paperwork right, run it by your CPA, run it by Bill, run it by everybody in the world. But we just put out there an opportunity for you, numbers geeks and tax, people. If you want to jump in and spend time on that, this little tidbit there. Right?
Absolutely. Yep. A lot of planning opportunities. It's all about planning. And if you have time to sit down and kind of, work through what you're doing, how you're doing it, how you document it, you can get to almost anywhere if you got time.
You know what would be an awesome service for you to offer, and maybe you already do, is for me to go, hey, Bill, let me just dump my whole life on you and tell you my situation and pay you a consulting fee, and then you just tell me how I should set up myself. That's like, they have, what are those people are using, some of those NCH, they tell them how to structure their whole company and have this company own that company and this and that, and they pay, $5,000, $10,000 for that information. Do you do that?
We do some of that when it gets to rental or investment property. We can certainly do a consulting arrangement and kind of look at how it's set up, how it's structured, so that you have the opportunity to sell on a tax favored basis in the future.
Yeah, like if you are somebody that's built up a portfolio for your whole life and your stuff, I mean, something to think about, guys. All right. Well, we're going to keep you on the phone here forever. We don't want to go too long. Is there any other of these questions that you had that you want to cover that you think would be the most pertinent to share?
I think we're probably pretty good. I guess the last thing I'd want to kind of throw out there is if you own property in some type of an entity, living trust, LLC, corporation, etc., now's the time to talk to your advisors to find out, who is the real taxpayer. And probably the best example is an LLC. Investors come together, set up an LLC. Maybe you have 2, 3, 4 investors who fund the LLC and then go and co-invest together. And then when they decide to sell, they usually want to do a 1031 exchange. But the challenge is that they don't own real estate. They own a membership interest, which is a partnership interest in the entity. The real owner of the real estate is the LLC. So if the LLC is going to stay together and exchange together, that's no problem. But a lot of times the investors have decided it's time to go different directions. And in that case, they're not the sellers. The LLC is the seller. So it can be addressed. We just need time to plan for that. So, if you've got co-investors in some type of an entity, talk to your advisors about what your exit strategy might be. And then that way you're prepared for the ultimate sale.
I have been, I'll call burned by that. I know what you're exactly talking about. I would say to everybody, how I feel like they do that, maybe I'm wrong or not, they do some sort of assignment of your interest to the other members, and then you either get hoodwinked by them saying, well, we'll give you your proceeds, or maybe there's an opportunity for you to charge an assignment fee, which is what I have done in the past when we were essentially breaking up. Still, it sucks. I would have the right is there a way for me to then go do my own 1031, right?
It is possible, yeah. It depends on all the moving parts. And if everybody's willing to cooperate, yes, there's always a way to work it out. It all depends on how much time we have.
Right.
When we get a call and they're closing escrow tomorrow, it's very difficult, but it's still possible if everybody's willing to cooperate.
Right. So I'll just give you a tip from my own experiences, guys. When you have a partnership agreement and somebody else is running the show and you're not the main managing partner or something like that, make sure in your agreements that it says that you will be and shall be notified of any intention or thought to sell immediately. Because if they say, hey, we're selling the property, we've already got a buyer lined up, and you're a limited partner, or you're you're more of the silent partner in the thing. You just got side. We're not going to exchange together. You just got slammed with no time to take care of what you need to take care of on the exchange stuff. So I've had to do that on my own partnership agreements, just even an attempt to be told, as early as possible if that's going to be coming down. So a lot of things to think about there in case you have
Absolutely.
Well, that's all awesome. We could talk
and unfortunately, breakups happen a lot.
They do, and they don't necessarily happen for bad reasons. It just sometimes they happen, Let's see. Well, Bill, we've been taking up so much of your time. We would love to have you come in person to Seattle Investors Club, and we get a crowd there for you. I'm sure we draw a big crowd for you. Your information is crucial. If you're in the real estate investing business, I think you should have a real estate license, and I also think you should have a team of experts, one of those being, the worst thing that can hurt you. Real estate can be great. You can make a lot of money, and then you can just get spanked if you don't handle the taxes correctly and plan that correctly. I know because I've been through some of that pain myself. Where can our listeners, do you have a blog or what are they, how do we stalk you, Bill?
Stalking is always good. They can go to the website, and all of our contact information is out there. And I'm the only Bill in the company, so they just have to ask for Bill, and they'll track me down. But the website is exeter1031.com.
Excellent. Do you have a newsletter or anything like that, or are you working on?
We do. They can subscribe through the website as well, and it's supposed to be monthly, but you know how that goes. So it's not always monthly, but we'll get it out there, and it's always educational type. And then if they want, there's a guidebook we can send them. It's about 20, 28, 29 pages. It's all on the basics of 1031 exchanges, and it covers all the things we've talked about. It goes in a little more depth, but it's designed to be concise. It's not too techy. So if they want that, we can email it or mail it to them.
Super awesome. Well, we are going to continue to twist your arm and try and get you back here to Seattle. I know you got some family.
I'll be happy to.
That would be fantastic. Joe is a point person on that. I usually do the talking, then I run the other direction. Try and get some deals done. Leave it to Joe, who runs the show for us. It's totally awesome setup we've got here. But thank you so much. This has been super informative. I love when I can get selfish and get my own free advice and questions in while we're rolling through these things. But
sure, anytime.
It's been a pleasure. And other than that, we'll turn you back to the beautiful San Diego weather, and we'll let Joe hit the trail, and Buddy and I will hit the streets and go take a walk.
Perfect. Well, thanks for having us, and I look forward to seeing you up there.
Sounds good. Joe, where can they find this podcast, or what do we need to know?
Yeah, guys, the podcast notes can be found at seattleinvestorsclub.com/40. And if you guys enjoyed this podcast, we'd also love for you to give us a review on iTunes at seattleinvestorsclub.com/iTunes. If you ever have any questions, let us know. All right, guys. Have a great day. It's good chatting with you.
Likewise. Take care. Bye-bye.
Bye-bye.
Thanks for listening to the Seattle Investors Club podcast. If you have questions that you'd like to have answered on the show, shoot us an email at info@seattleinvestorsclub.com. Now go out, take that action, and build that real estate business. Thanks for listening.